Committee to come to order. Without objection, the chairs are authorized to declare a recess of the committee at any time. This hearing is entitled Examination of Legislative Proposals to Provide Targeted Regulatory Relief to Community Financial Institutions. And before I begin today, I'd like to thank the witnesses for appearing. Appreciate your participation. I look forward to your productive discussion. Also want to, one of the reasons we have such a light crowd today is we're expecting votes any minute. So I apologize for that, sir, but we're going to try and get as far as we can with your testimony. And when the votes occur, we'll take a recess for probably 30 minutes to an hour. Appreciate your indulgence, and we'll be back to continue the discussions, okay? With that, I now recognize myself for 4 minutes for purposes of delivering an open statement. This subcommittee has spent a great deal of time exploring the many burdens facing financial institutions. I've heard from my friends on the other side of the aisle that there's a willingness to work across party lines to offer regulatory relief, particularly to community banks and credit unions. Today, we'll have an opportunity to do just that. The work our subcommittee has done this year has led to the creation of many of the bills we'll consider today. Our first hearing served to examine the lack of a de novo bank and credit union charters. As a result, the gentlelady from New York, Ms. Tenney, has drafted legislation to streamline the de novo process. We've also held hearings regarding the appropriate role of federal financial regulators. The Vice Chairman, Mr. Rothfuss, of this subcommittee, has legislation to fundamentally change the appeals process, allowing financial institutions to have a fighting chance in what seems to be a process with predetermined outcomes that benefit financial regulators. Other members have spent considerable time and energy developing legislation to balance the demand for access to credit with a more responsible and regulatory regime. Of particular importance to me is one of my bills, H.R. 2133, the CLEAR Act. This legislation is a compilation of provisions to offer targeted regulatory relief for community banks and credit unions. The aim of my legislation is to make mortgages more affordable, demand more accountability from Washington regulators, and ease requirements on the nation's smallest institutions and businesses. Many of the members of this subcommittee have offered their assistance with provisions included in the CLEAR Act, and I'm pleased they will have an opportunity to discuss them today. And while we'll spend the bulk of the afternoon talking about specific measures to offer relief from regulation, what must not be missed is the impact this relief will have on our local economies and consumers. The greatest impact of Dodd-Frank and other Obama-era rules has been on the consumers, the customers of our financial institutions. An example is Michelle from Fulton, Missouri. She told me that her daughter, despite having a full-time job, could not get a loan to buy her first car. Then there's Matt, a banker in southeast Missouri, who said the regulatory climate makes it harder to write a loan with terms that may be in a customer's best interests. Despite what the federal financial regulators would lead you to believe, Washington does not know best. The supervisory and regulatory structure experienced today leaves little to no room for flexibility or innovation, despite the fact that American consumers and small businesses continue to struggle to get the financial services they need to pursue growth and economic freedom. It's past time to demand a reasonable regulatory structure that fosters economic opportunity while allowing for robust consumer protection. The 9 bills we will discuss today seek to make modest changes in an effort to return to a more reasonable regulatory structure. We have a distinguished panel with us today. We look forward to your testimony. The chair now recognizes another gentleman from Missouri, Mr. Clay, the ranking member of the subcommittee, for 5 minutes and for an opening statement. Mr. Clay.
Thank you, and let me first thank you, Mr. Chairman, for holding this hearing to review proposals to provide regulatory relief for smaller institutions, and thank each of the witnesses for your input on these important issues. I'm certainly willing to consider and support tailored regulatory relief for smaller-sized institutions, but before adopting legislative changes, we should be 100% confident that the proposal is actually designed to provide tailored regulatory relief to community financial institutions and not the large banks, and that any special consideration for community banks and credit unions will not expose consumers to abusive and predatory practices. As the subcommittee reviews these proposals, I hope my colleagues will not forget the lessons learned from the financial crisis. We must understand the true state of the financial services industry in this country today and reject the false claims that the Dodd-Frank Act has harmed banks and consumers. I believe that regulatory relief should always be done with careful consideration in order to protect the safety and soundness of our financial system, ensure the independence of our financial regulators, and combat shoddy practices by bad actors that harm consumers. Last, I want to call upon my colleagues to actually show their support for community financial institutions by working with me to ensure that Congress does not follow the Trump administration's proposal to slash funding for CDFI fund in fiscal year 2018, which provides valuable funding to our community financial institutions and the communities they serve. Thank you again to each of today's witnesses, and I yield back the balance of my time.
Gentleman yields back. With that, we will begin the testimony. We want to welcome each of you again. We begin with Mr. Robert Fisher, President and CEO of Tioga State Bank, on behalf of the Independent Community Bankers of America. Mr. Rick Nichols, President and CEO of River Region Credit Union, on behalf of the Heartland Credit Union Association. Mr. J.W. Verrett, Associate Professor, Antonin Scalia Law School and Senior Scholar at the Mercatus Center, George Mason University, and an alumnus of this Financial Services Committee. Welcome back. And Mr. Scott Estrada, Director of Federal Advocacy Center for Responsible Lending. Also like to take a moment of personal privilege to extend a special welcome to Rick Nichols, whose credit union serves members across my district. And every day, Rick and his staff work to ensure that Missourians have the ability to pursue economic freedom and create better lives. Rick, thank you for making the trip from Jefferson City. Certainly appreciate your participation today. I know the ranking member would agree as well. It's nice to have another Missourian on the panel. And knowing Rick, he comes from a little town just like I do, so welcome to the big city. With this, we will begin the questioning, and we'll explain the light system real quickly here. Green means go. With 1 minute left, you'll see a yellow light come on, and that means you got 1 minute to wrap it up. And when red comes on, I have the gavel, which means I get the last word, and so it may be stop. So, but we'll work with everybody as best we can here to make sure you get your points made. With that, Mr. Fisher, you're recognized for 5 minutes.
Chairman Luke DeMeyer, Ranking Member Clay, and members of the subcommittee, I am Robert Fisher, President and CEO of Tioga State Bank, a $475 million community bank in Spencer, New York. I'm pleased to be here on behalf of the nearly 5,000 community banks represented by Independent Community Bankers of America. We hope today's hearing sets the stage for legislation needed to strengthen local economic growth and job creation. Tioga State Bank was founded by my great-great-grandfather in 1884 to provide needed banking services to local businesses and individuals. I'm a fifth-generation community banker proud to carry on our commitment to the local prosperity. Today, we specialize in consumer mortgage and small business lending. Many of the rural communities we serve in upstate New York depend on us as the only financial institution with a local presence. These smaller communities are simply not on the radar of larger banks. I'll focus my testimony on 4 bills before this subcommittee, all of which include provisions recommended in ICBA's Plan for Prosperity. First, H.R. 2133, the CLEAR Act, is a package of provisions chosen to provide relief from some of the most egregious aspects of regulatory burden, government overreach, and legal risk facing community bankers today. ICBA is grateful to Chairman Luke DeMeyer for introducing this important bill, so thank you. Approximately half of the bill's provisions address different aspects of mortgage lending. No area of community banking has been heaped with more new regulations in recent years, to the detriment of borrowers everywhere. As a portfolio lender, I appreciate the needed flexibility provided by the CLEAR Act. Loans held in portfolio would automatically have qualified mortgage status. This is a simple, clean solution that would avoid the inflexible requirements and torturous analysis mandated by the CFPB's ability to repay rule. Loans held in portfolio by a bank with assets of less than $10 billion would also be exempt from costly escrow requirements for tax and insurance payments. And loans less of less than $250,000 would be exempt from appraisal requirements. In our market, an appraiser shortage is escalating prices and lengthening turnaround times. ICBA thanks Chairman Kustoff for introducing this provision of the CLEAR Act in a separate bill, the Access to Affordable Mortgages Act. Such flexibility is safe and reasonable because portfolio lenders bear the full risk of default and have every incentive to ensure the loans they hold are affordable for the borrower and appropriately collateralized. Another provision of the CLEAR Act would be to raise the HMDA exemption thresholds so that community banks like mine would not be forced to complete 48 data fields for every mortgage application we receive. In rural communities that I serve, where people are well known to each other, published HMDA data is a threat to consumer privacy. The current exemption thresholds are much too low. Raising these loan thresholds will protect consumer privacy and provide regulatory relief for many more small lenders without a significant impact on the mortgage data available to the CFPB. In addition to the mortgage lending reforms, the CLEAR Act would fully repeal Dodd-Frank Section 1071, a small business loan data collection requirement which has not yet been fully implemented. In my opinion, as a commercial lender, this is one of the most important provisions of the CLEAR Act. Commercial lending is a complex business with customized terms, covenants, and rates based on numerous factors unique to each borrower. This type of lending cannot be commoditized in the way that consumer lending can, nor can it be subject to simplified, rigid analysis, which may generate baseless fair lending complaints. I believe that Section 1071 will have a chilling effect on lenders' ability to price for risk. This, in addition to the expense of data collection and reporting, may drive community banks from the commercial lending market and curb access to small business credit. Other provisions of the CLEAR Act are discussed in my written statement. ICBA also supports H.R. 924, the Financial Institutions Due Process Act, introduced by Representative Rothfuss, which would reform the appeals process for exam findings and bring a higher level of accountability to the regulators and their field examiners. And finally, H.R. 2148, the Clarifying Commercial Real Estate Loans Act, introduced by Representatives Pittenger and Scott, would provide relief from punitive new Basel III capital charges for commercial projects that promote local economic development and job creation. Thank you, and I look forward to taking your questions.
Gentleman's time has expired. With that, Mr. Nichols, you're recognized for 5 minutes.
Thank you. Good afternoon, Chairman Luetkemeyer, Ranking Member Clay, and members of the subcommittee. And a special thank you for the gentleman from Missouri. Welcome, good to see you. Thank you for the opportunity to appear before you today. As you noted in my introduction, I am the president and CEO of River Region Credit Union in Jefferson City, Missouri. By any stretch of the imagination, my credit union is a small institution. We're about $200 million in assets, and we serve about 22,000 members. As a result of the tidal wave of new regulations coming out of the financial crisis, credit unions like mine, as well as many small banks, are forced to operate in a regulatory environment that is rigged in favor of large institutions. When Washington produces one-size-fits-all regulations designed to rein in Wall Street banks or abusers of consumers, my credit union feels the impact more than Bank of America and Wells Fargo. They have an army of compliance attorneys and all the resources in the world. I don't. The system is creating too big to fail banks that put all American consumers at risk. I appreciate that the subcommittee is looking at legislative proposals to provide targeted relief to community financial institutions. We're being painted with the same brush of those who commit abuses. Overregulation is leading to a decreased number of smaller institutions that know their communities and work with the people they serve every day. Relief cannot come quickly enough. America's credit unions and the 110 million members we serve, including 1.5 million members in the state of Missouri, support many of the bills that are under consideration. We support Chairman Luetkemeyer's H.R. 2133, the CLEAR Act. This legislation includes several common sense solutions that will help my credit union. Specifically, we support provisions that would adjust thresholds for mortgage servicing and escrow account administration, exempt certain higher risk mortgages from appraisal requirements, repeal NCUA's 2015 risk-based capital rule, modify CFPB's UDAP authority, improve CFPB's final HMDA rules, repeal the CFPB's authority to collect small business loan data, end Operation Checkpoint, give consumers the right to waive waiting periods on mortgage closures, increase CFPB supervisory authority threshold to $50 billion in assets, treat mortgages held in portfolio as qualified mortgages, and transfer authority to define ability to repay to the FHFA. We also support H.R. 924, the Financial Institutions Due Process Act. This bill brings fairness to an examination process that is not always transparent and an appeals process that has never been balanced. It is important for federal regulatory agencies to be able to cite the authority under which they are making material findings during the examination process. Further, it is critical that if there is a dispute between the financial institution and the examiner, that such dispute be heard in a venue independent of the examiner's chain of command. H.R. 924 achieves both of those objectives. We support H.R. 1457, the Mobile Act. This legislation is an important step toward helping credit unions and other financial institutions remain competitive in a market increasingly disrupted by financial technology companies, who are often subject to fewer regulatory requirements. To the extent that this legislation makes it easier for consumers to join credit unions, we view this as a positive step. We also support H.R. 2396, which makes changes to the privacy notification requirements that will make compliance much easier. America's credit unions greatly appreciate the subcommittee's work on these targeted regulatory relief proposals. The complexity of the crisis facing community-based financial institutions mean that one piece of financial legislation is unlikely to remove all the obstacles facing these institutions in serving consumers. There is much, much more work to be done. In conclusion, we encourage the subcommittee to continue to pursue additional measures to provide meaningful relief to community financial institutions like River Region Credit Union. It's important to keep in mind the people that these regulations affect. For example, this folder, I won't make you read it, this folder is a 30-year mortgage loan. This is all the documents that our members receive in a 30-year mortgage. Every time we pass something, it's just another piece of paper for them to see and less information that they actually understand. Thank you for the opportunity to testify in front of the hearing. I look forward to answering your questions.
Thank the gentleman, and just a quick question. How many pieces of paper are in that folder? Do you know offhand?
As I told them, we quit measuring by pages, we now measure by pounds.
Okay. How many pounds have you got there?
I'm guessing that one to be about 7 pounds.
7 pounds of paper. Okay, thank you very much. Great visual aid. Thank you very much. Mr. Estrada, you recognize for 5 minutes. Thank you for being here.
Thank you. Good afternoon, Chairman Luetkemeyer, Ranking Member Clay, and members of the Financial Services Subcommittee on Financial Institutions and Consumer Credit. As noted, I'm the Director of Federal Advocacy at the Center for Responsible Lending, CRL, a nonprofit, nonpartisan research and policy organization dedicated to protecting home ownership and family wealth by working to eliminate predatory financial practices. On behalf of CRL, I'd like to thank you for allowing me to testify today to discuss proposals regarding regulatory relief for community financial institutions. This important hearing addresses the health of our small banks and community lenders in the context of the regulatory structure created in the wake of the Great Recession, a regulatory framework that corrected systemic gaps and sought to prevent future market failures, while providing essential protections to consumers and the overall economy. In setting and implementing these safeguards, regulators have utilized a two-tier approach with numerous measures intended to decrease compliance costs for smaller lenders and institutions. This approach should be continued and expanded. However, dismantling essential reforms such as the mortgage ability to repay standard, expanded QM exemptions, or reducing the effectiveness of the Consumer Financial Protection Bureau would severely harm consumers, banks, and the overall economy. The 2008 Great Recession has showed us the consequences of a financial marketplace where there are no basic protections, accountabilities, or transparency. The result was 7.8 million Americans losing their homes through foreclosure, taxpayers on the hook for $7 trillion to bail out financial institutions, and an additional $22 trillion through the federal government's purchase of assets. According to the FDIC, more than 500 banks closed their doors, with most of these institutions small community banks. These consequences remind us why the safeguards of the Dodd-Frank Wall Street Reform and Consumer Protection Act are needed to protect consumers and our nation's economy. All financial institutions, including community banks and credit unions, benefit from the underlying purpose of financial regulation: protecting consumers, ensuring the safety and soundness of institution, and defending the nation's financial market from systemic risk. Today, financial institutions, including small banks, are recovering steadily. Contrary to theories that Dodd-Frank has stifled growth, the financial sector has seen record profits, community bank profitability has rebounded strongly, and credit union membership is growing, and mortgage lending has also steadily recovered. Community banks and small lenders play an important and growing role in the mortgage market, and loans originated by smaller lenders with assets under $1 billion saw the biggest increase between 2012 and 2015, and credit unions alone originated $41.7 billion in first lien mortgage loans in the third quarter of 2016, an increase of 22% over the same period of the previous year. CRL supports reasonable regulatory flexibility for small depositories. However, we strongly oppose any effort to use regulatory relief for small lenders as a free pass for non-banks and larger financial institutions to avoid reasonable regulatory scrutiny. Just as important, federal financial regulators like the CFPB must be allowed to both protect the American people and ensure a fair and sustainable marketplace. The CFPB independent structure and funding should remain as Congress intended so that the Bureau may continue its work without gridlock or political interference. Rather than pushing proposals that drastically roll back important safeguards for consumers and community banks, we should be working on pragmatic, broadly supported proposals that provide regulatory relief. For example, further clarification of the False Claims Act liability for FHA loans is needed to reduce uncertainty and protect responsible lenders. Another reform is to raise the QM safe harbor from 150 basis points over APOR to 200 basis points. This would substantially reduce the number of mortgages that are classified as higher cost and excluded from safe harbor status. Finally, a major area of relief could be provided around the Bank Secrecy Act and anti-money laundering rules compliance. BSA AML compliance is a huge regulatory burden, and according to the American Bankers Association, is especially burdensome for community banks and credit unions. These laws carry out the essential and critical need to prevent our financial institutions from being used by criminal enterprises to facilitate illegal activities. Currently, the onerous task of determining the true identity of owners of accounts falls on the financial institution itself. The ICBA and others have asked that federal and state agencies verify account ownership information at the time the entity is formed, and bipartisan bills have supported this solution and have been endorsed by the Clearinghouse Association. CRL is ready to work with this committee, community banks, credit unions, and their associations and regulators to ensure that all of these objectives are satisfied through laws and reasonable regulations. Thank you again for the opportunity to testify today, and I look forward to answering your questions.
Thank you, Mr. Estrada. Time's expired. Professor Verrett, we welcome you, and you have 5 minutes. And before you get started here, we have had votes called, and so what we'll do, members of the panel, we will have the testimony of the professor, and at that time, when he's finished, we'll call a recess, we'll go vote, and we'll come back, okay? But I think we've got about 12 minutes left before we have to vote. So, Professor, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Clay, and Vice Chairman Rothfuss, I appreciate the opportunity to testify today. I'm J.W. Verrett. I'm a professor of banking and securities law at Scalia Law School, and I work with the Mercatus Center. I want to begin by noting that the legislation under consideration today includes vital reforms to the bank exam process and to the CFPB and its rules. These changes will begin to alleviate barriers to entry, which have made it all but impossible to open new banking institutions in recent years. As the dual banking system evolved over the 150-year period since the Bank Act of 1863 was first adopted, a number of states set up intentional barriers to entry to prevent out-of-state institutions from competing with home state banks. But Congress and federal regulators eventually stepped in to promote interstate branching, first through holding companies and then through efficient preemption of anti-competitive state rules. We stand at another such juncture where bank regulatory reform is vital to the national interest, and so I commend this committee's attention to that. The exam process for banks is unique in the American regulatory structure. In no other field of regulation is the relationship between regulator and regulated so close-knit. Examiners take up residence in institutions. Communications to them get limited legal privilege, similar to one's spouse or attorney. The exam process can work well and can help remedy financial problems, particular to an institution, without harming the bank's reputational capital. But it can turn ugly when it goes bad. Banks report examiners have sometimes issued retributive threats for opposing rules in a public notice and comment, or have issued inappropriate demands that amount to shadow regulation. Legislation featured today will begin to ameliorate some of these problems. Turning to the CFPB, which is one of the most powerful regulators in the financial services space, yet it is also the youngest. The Federal Reserve is 100 years old. The OCC dates back to the Civil War. These agencies benefit from regulatory culture and a wealth of legal precedent defining their operative statutes that have evolved collectively over hundreds of years. The CFPB, on the other hand, is 6 years old, and I don't need to remind this committee of the growing pains it has already experienced. That's why the proposed change to the broad authority of the CFPB under UDAP is so essential. Words have power in the law because they can be defined over hundreds of fact patterns in which impartial judges give words meaning. The words deceptive and unfair have such a clear meaning, developed over decades of implementation by the Federal Trade Commission. The word abusive does not. Now, I know it's easy to accuse someone making a legitimate argument about statutory meaning of being, quote, in favor of abusive products, and it's an old Washington trick. I challenge any who oppose this change, however, to describe a set of facts that would be considered abusive but not count as deceptive or unfair under the statute. Another bill proposed today would establish an intent requirement for violations of ECOA. The CFPB describes itself as a law enforcement agency, and indeed the penalties it collects are often large enough to blur the line between civil and criminal sanctions. Our criminal laws overwhelmingly recognize an intent or scienter requirement in offenses, recognizing that unintentional actions taken by people doing their best to follow the law are not morally blameworthy. Courts interpreting ECOA have also recognized this need for an intent requirement in order to award punitive damages under the ECOA statute. I would further argue that a clear reading of the ECOA statute in light of the Holding Inclusive Communities indicates it does not permit actions based on a theory of disparate impact. I also commend the committee's attention to the use of reputation risk in bank regulation and supervision. Citing to amorphous reputation risk has become a new fad among bank regulators in recent years, both in justifying rules and in the CAMELS rating process, and it is highly problematic. First, regulators have yet to demonstrate that reputation risk is a necessary component of the CAMELS rating and of examination, since existing financial and management measures would capture the effect of any reputational problems among bank customers. Second, regulators refuse to use the empirical tools available to them to measure reputation risk, such as stock price event studies or hedonic consumer price studies. And the close association, frankly, between this regulatory tool and the Operation Choke Point scandal suggests that careful scrutiny is warranted. There are a lot of bills on the agenda today. I know I've only touched on a few issues in some of them, but I thank you for the opportunity to testify, and I look forward to answering your questions. And may I say, it's good to be back. Feels like home. So.
Thank you, Professor, and thank each of you for your testimony. We do apologize for this interruption, but we do have a little some things we need to be doing here. So we need to take care of some votes. I think we have 3 votes, so we should probably be back around the top of the hour, a little bit after. With that, I'll call for recess. committee back into session. A couple housekeeping things to take care of first. Again, thank you, witnesses, for your indulgence. Without objection, each of your written statements will also be made part of the record. And without objection, the gentleman from Minnesota, Mr. Emmer, and the gentleman from Indiana, Mr. Hollingsworth, are permitted to participate in today's subcommittee hearing. While not members of the subcommittee, Mr. Emmer and Mr. Hollingsworth are members of the Financial Services Committee, and we appreciate their interest and participation today. So they'll be able to ask questions and participate here shortly as well. So with that, let me recognize myself for the purposes of asking questions for 5 minutes. Again, thanks to each of you for being here. Mr. Nichols, you represent the credit unions, and a lot of the discussions you had earlier with regards to the CLEAR Act and some other bills. What would it mean from the standpoint of cost to your organization to have the bills passed that we're talking about today? What kind of costs, and how would it affect your customers?
The cost almost is immeasurable. We were just talking about the amount of people that I have involved in compliance. Again, we're a very small institution, $200 million. I have 2 dedicated people in compliance, plus I have another 6 to 8 people who spend a significant portion of their time in compliance. As we look, I'll pat this mortgage packet once again. That's a post-TRID mortgage packet. TRID, by most accounts, doubled the amount of time that it took to complete a mortgage loan. So if you really look at that, my cost, obviously there would be a savings. The cost to the consumer, my owners, my members, every dollar that I save, I pass on to my members, so that it is immeasurable.
Mr. Fisher, you made quite a bit of a discussion with regards to the portfolio, being able to hold some of the loans in portfolio. Would you explain that and explain how important it is to an institution of your size to be able to do something like that?
As a portfolio lender, we do sell some loans off to the Federal Home Loan Bank, but the majority, probably 65 to 70% of every mortgage we write, we hold on our books. So we bear the full risk. If a loan goes bad, we take the loss. Nobody else takes the loss. It's our bank that takes the loss. So it's to have QM status on anything we hold in portfolio would be very valuable to us. And it's
Does it deter you from making loans to have this QM status, not being able to hold all of them in portfolio?
We've always been kind of a non-traditional lender, so we've always done a lot of non-conforming mortgage lending. So when they came out with a qualified mortgage status, we made a decision that we were not going to not do non-QM loans. So we continue to make non-QM loans today, and we've decided that to take that risk on. But I do know a lot of bankers that have exited the mortgage business or do not do any non-QM lending.
You know, it's interesting, Mr. Nichols, with your pile of papers next to you there. I was talking to the banker the other day, and he said, you know, I can do a $50,000 brand-new truck loan in about 60 to 90 minutes, and it takes me 60 to 90 days to do a $50,000 home loan. And then you have to spend $2,500 probably to put that packet of papers together for the individual. Plus, you look at the assets that you have as collateral. One is appreciable and it's going to be movable, can leave the country. The other one is stationary and probably appreciate. We've got a huge disconnect here in my mind with regards to how we look at housing finance. I know in the CLEAR Act, what we want to do is take some of those HMDA things back down to 2008 levels so people can actually knock off some of the cost and some of the nonsense that you're having to put up with here. And I'm sure every single person that comes in your institution reads every one of those pieces of papers too, right?
That's part of the issue, is the more paper we give them, the less they end up reading by nature. So
it's interesting because my father passed away a few years ago, and my mother passed away a few years before that, and my brother and I sold our home, their home. And so it took me 9 signatures and an initial to sell our property, to sell the property. That's not to go buy it. The buyers had to do that. I still had a packet of papers this thick. That's how out of whack this whole system is. Thank you very much. Professor Verrett, you talked a little bit about the abusive practices and reputational risk This is something that really irritates me with regards to the regulators. They can't define either one of these things, yet they throw them at the bankers and the credit union folks as a way to intimidate them into doing things. Would you like to elaborate just a little bit on how over the top this is and how irrational some of these discussions are?
Yeah, I think a prime example has been the use of reputation risk in the physical commodities rulemaking that the Fed was considering for a time that I think they probably dropped with the change in administration. I sit down and ask these guys, how are you measuring reputational risk? And they'll try to tell me, well, you can't measure it. Or they would say, well, it seems like some banks have gotten out of this, and so it must have been risky. And I asked them, maybe they got out of it just because of the attention from his GAC and because of your complaints. Maybe you're the reputational risk to the banking system. And then they would talk to me about the size of potential liability, and I would say, they pay billions of dollars a year in securities class actions. Are securities class actions, is being publicly traded, a reputational risk to the banking system? And they would say, does not compute, don't know how to answer that question. It's a nonsensical approach, I would.
Okay, thank you very much, Professor, and appreciate everybody's comments. I'm out of time. With that, we go to Mr. Scott from Georgia. He's recognized for 5 minutes.
All right, thank you, Mr. Chairman. First of all, I want to thank Mr. Pittenger, I believe he's here, for working with me and my staff to put forward H.R. 2148. And because of this bipartisan work, we're able to introduce bipartisan legislation that will clarify pesky commercial real estate rules. Now, let me explain why we need this bill. First of all, the commercial real estate loan industry works in a somewhat complicated way. But starting in 2015, real estate loans that are classified as an HVCRE, which is high validity commercial real estate loan activity. And for those watching on C-SPAN, you see what I mean when oftentimes we make things a little more complicated. But because of that rule, overnight, it became much more expensive because of the rules from the FDIC to the industry. Now, let me be clear that the financial crisis saw a lot of banks go under because of their heavy exposure in risky commercial real estate. I might add that my dear state of Georgia led the nation in bank closures repeatedly during this period for a number of years. So moving to add more capital cushion to the riskiest of loans does make a lot of sense. However, the FDIC wrote an overly broad and very vague rule that failed to grasp the real-world problems in this area. So all our legislation does is provide the clarity of which types of loans should and should not be classified as these HVCRE loans, high validity commercial real estate loans. Now, our Mr. Pittenger and my legislation does not eliminate the FDIC's ability to require banks to hold higher capital for these loans. Our language does nothing to the higher standard that was set in 2013. So that's our bill, but we have two distinguished CEOs of banks on the panel, Mr. Fisher and Mr. Nichols. I'd like to know what they've seen firsthand. You guys are out there in the field getting the crops in on all of this. We're just in here trying to give you a level playing field and be able to conduct your business. Tell us what's happened in the construction financing side, real estate side of your business since 2015 when these HVCRE, high validity commercial real estate loans came out.
Well, Congressman, I appreciate the question and the bill. ICBA obviously is supportive of this bill. Where I'm at in upstate New York, we have not had a great deal of commercial activity as far as a lot of commercial real estate expansion. We do a lot of commercial real estate financing, but we don't have a whole lot of HVCRE in our market. So I don't know if Mr. Nichols has experienced anything different, but we would support, obviously, a simplification and clarification of the current rule that's out there, so we appreciate that.
Yeah. Mr. Nichols?
Congressman, as I understand it, that bill is FDIC specifically, and the credit unions don't have a position on that.
Okay. Very good. Let me go to another bill that we have that I'm sort of working with Mr. Tipton, and ask you again, Mr. Fitch, or anybody, about House Resolution 1457. And there's no doubt that customers are relying less and less on walking into a branch for their banking needs instead of turning to their phones. But another trend is happening simultaneously, which is an uptick in bank mergers. This is particularly impactful for rural communities in my district who usually only have one bank within miles from where families live. And this means that Americans' taste for walking into branches is declining. So Mr. Tipton's bill, which I'm also sponsoring the Mobile Act, caught my attention because it addresses these headwinds facing community banks by creating a uniform nationwide standard where banks can easily scan driver's license, state's ID using a mobile device. My time is up. Maybe I'll have a chance to come back and ask you more about that. Thank you, Mr. Chairman.
With that, we go, the gentleman's time has expired. With that, we go to the gentleman from Pennsylvania, the Vice Chair of the committee, Mr. Rothfuss is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Fisher, I often hear from small business owners who complain that they have difficulty getting bank loans after an off year, despite having ample collateral or a strong track record. When I discuss this issue with community bankers, they usually tell me that they are wary of making loans to customers with suspect cash flow because they are concerned about receiving criticism from regulators. In other words, bankers who know that a potential borrower has sufficient collateral and a strong track record are being discouraged by regulators from exercising their discretion and providing capital to small businesses. Is this a problem that community banks like yours often face?
We often are criticized on certain loans that we make, even to longer-term customers. I mean, we've had loans on the books where maybe a customer, as you mentioned, has one bad year out of 3, and the loan gets classified or written up as being a substandard loan. So one bad year does not necessarily mean it's a bad loan. The loan's still paying as agreed. So I would, it obviously has a negative impact on us making future loans.
Do you believe that the regulators are arbitrarily discouraging banks from providing loans to small businesses that banks have confidence in?
I'm not sure if it's arbitrary. I believe that sometimes it's a focused effort to discourage us from making certain types of loans at times.
Do you view the current examination process as a hindrance to small business access to capital?
I can tell you that the current examination process is a hindrance to making loans and doing business. I get, from the time I get my first day letter to the time I close out an exam period or the on-site examination, our focus is not on serving our customers. Our focus is on serving our regulators or examiners that are on site. And if I look back at probably a 10-year earning history, quarterly earning history, I think I could pinpoint exactly each quarter that I've had an examination by looking at our earnings for that quarter.
Can you suggest some ways Congress can address this?
I think just having a more focused examination approach and maybe even reducing the number of examiners maybe that come on site, not having I'm a $475 million bank. For our safety and soundness exam, I think we had 10 or 12 examiners on site for a safety and soundness examination, which seems a little overkill.
Mr. Nichols, I'd like to ask you a question. I had a conversation with a small business banker, could have been in any other circumstance, a credit union, who recently told me in a troubling story about a disagreement he had with his on-site examiners. When the examiners told the regional office of the disagreement and conveyed the banker's desire to appeal the examination conclusion, the regional officer for the regulator arranged a call with the bank and its legal counsel. The regional officer for the regulator conceded during this call that the bank had the right to appeal the matter, but strongly advised against doing so. He then informed the bank that he had already spoken to the so-called independent regulatory reviewers and that the bank would lose its appeal. Based on my experience, these stories are not uncommon. They serve to underscore the importance of the Financial Institutions Due Process Act, which creates a fairer, more independent, and more transparent process. Do you see the need for an impartial system of checks and balances to ensure that disagreements with regulators are handled fairly and on a timely basis?
Absolutely. From a clarity standpoint, I can't agree more with what Mr. Fisher said. From a clarity standpoint, if the laws are written black and white, we could see what the law is, and there aren't ambiguous rules that we're supposed to be paying attention to. It makes it a lot more clear for us. If we disagree with those examination findings, there should be an independent process that we can follow through outside of that chain of command.
You know, I was struck looking at and listening to some of Mr. Estrada's testimony and his written testimony. Financial regulations are not slowing economic growth or preventing lending. You know, I read a piece recently by an economist, Steve Strong, and who talked about the two-speed economy. You know, the big firms are doing fine. They're lending. It's rosy, almost as rosy as the picture painted in Mr. Estrada's testimony. But then there's the slow lane. You know, that there are a lot of folks struggling out there. And Mr. Strongen estimates that as a result, directly because of the financial regulation that we've seen over the last 8 years, there are 650,000 fewer small businesses and 6.5 million fewer jobs. I wonder if you had any reaction when you were listening to Mr. Estrada's testimony. Mr. Fisher?
Well, obviously, I didn't agree with most of his testimony that he gave. I do feel that a lot of the regulation, especially if you look at my market in upstate New York, we're really struggling. We've never fully recovered from the economic crisis. So while I do believe that there's been some positive impact in other areas of the country where the recovery is stronger, it's still a struggle in my market, and regulatory efforts make that difficult.
Yield back.
Gentleman's time has expired. With that, we go to Mr. Meeks of New York. He's recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you to our witnesses in this important hearing. And although there are some proposals on the table that raises some serious concerns for me, there are others that I believe have the potential for strong bipartisan support. And in my view, if we work together and we can improve some. I, for one, have always been a supporter of encouraging banks and credit unions, which are highly regulated institutions, to re-enter and/or enter the small dollar lending space. I think Mr. Hollingsworth has made a sincere attempt to tackle this issue, but I believe the bill can be substantially improved by, one, increasing access to capital, and two, to maintain reasonably strong consumer protections. I think we still have to do those two things, but I look forward to working with Mr. Hollingsworth and his staff to address some of my concerns with this bill and to potentially reach bipartisan agreement on how we can encourage banks to re-enter the small dollar lending space as an alternative to less safe and costly alternatives out there. Because I know from my life's experience, folks are going to try to find a way when they need a small dollar loan, they need to get one, and I want to make sure that they have the protections, et cetera. So let me start with Mr. Nichols. So in your testimony, you mentioned that nearly 93% of credit unions offer or considering offering small dollar loan products to their members. Now, many disagree on what the appropriate underwriting status should be for small dollar loans given their size. Some argue that there should be no underwriting requirements at all. Others argue a different way. So my question to you is, from your experience dealing with the risks associated with these products, what is the most appropriate level of underwriting that should be required of a loan of less than $1,000, Mr. Nichols?
Let me start by saying I'm a member-owned organization. I serve every person that comes in to do business is an owner of mine. So when we talk about what dollar amount I should consider, it's what dollar amount makes sense for that member. So if a person comes in and they have a small dollar need, whether it be a new appliance, whether it be something to get them through to the next payday, we hear those stories. We deal with those people every day of the week. Every day, every circumstance is different. Every time is something unique. We use that for financial counseling. We work with them and say, let's develop a plan for you in the future. I don't know that, I know that all credit unions nationwide are designed that way. That's we're owned and operated by the people we serve. So that's what we're about.
That's extremely important, but so let me go to Mr. Estrada, because my concern that are individuals who are not members of credit unions, who need these small loans, and they have no place else to go. And I know from my old neighborhood, if they had to, and there's no one else that was going to give them a loan, they'd go to a loan shark. But since the OCC and the FDIC has issued depository advanced product guidance, nearly all banks that offered these products have discontinued their programs. So there's no banks on this small, most of them are all done. And although the OCC and FDIC's guidance includes principles that I'm supportive of, I'm still concerned that there are virtually no more banks that offer this product today. So, Mr. Estrada, do you have any alternative proposals policymakers can consider to incentivize banks and credit unions, we hear what the credit unions have to say, to re-enter the small dollar lending space, yet maintain reasonably strong consumer protections?
Thank you for that question, and thank you for your work on this. I would just preface that with the importance of that guidance and how the banks have withdrawn from that space as indication of how damaging that can be on communities. Once those bank loans look like payday loans, they have the same effects of payday loans. And CRL actually just released an issue brief today on the negative impacts of what we're calling bank payday loans. And we feel that before any innovation or before any proposal can have legs, we need to ensure that that guidance and those regulations and those protections for consumers that are seeking small dollar loans are not repealed or rolled back by current proposals. So I do look forward to working with your staff and continue to find actual suggestions, but until we ensure that the regulatory environment now doesn't repeal that guidance and keeps the bad actors from being predatory lenders, in essence, I think that should be the first step toward this discussion.
I'm out of time.
Gentleman's time has expired. With that, we go to the gentleman from North Carolina, Mr. Pittenger. He's
Thank you,
recognized
Mr.
for 5
Chairman.
minutes.
Appreciate your calling this hearing. I thank each of you for coming and for taking your valuable time to be with us on such a critical issues. I would like to speak to H.R. 2148, Mr. Fisher, that you brought up today, the HVCRE legislation. Would like just to get some personal thoughts on how this rule affected your commercial real estate lending activity.
I think commercial real estate lending in upstate New York is it's the majority of the commercial lending that I do. I mean, we do a lot of C&I and commercial real estate, but we don't have a huge amount of commercial real estate lending growth in rural upstate New York where I'm located. So it's
what is your understanding relative to the financial institutions, the banks, and the impediments that this rule has had for them in making commercial real estate loans?
I believe that we are in agreement with the legislation that you proposed, and we would definitely support this bill going forward. And I think it would be a positive impact on community banks' ability and clarify, some of the guidance as far as their lending. So,
Do you have some thoughts in terms of the economic consequences of not clarifying the HVCRE bill?
I think not clarifying it will continue to restrict commercial lending as far as definitely commercial real estate, HVCRE lending. So.
From your experience, would you believe that the regulatory agencies will resolve this issue, or do you believe that this legislation is warranted and necessary?
I think this legislation is definitely warranted and necessary because it's, if left up to the agencies, I'm not sure we'll get the clarification that you're providing.
If any of you want to pitch in on these issues, you're welcome to. I don't know particularly of your background in it, but would like to know of your concern about the economic consequences of what we refer to as the wall of maturities, which is approximately $1 billion a day of commercial real estate loan maturities.
I'm sorry, I didn't understand the question.
It's called the wall of maturities. What's your understanding of that and the $1 billion a day of loan maturities that we have, that the economic consequences of those?
I'm not sure I still...
Familiar with that? Okay. Well, are you concerned about the cumulative impact of the various Dodd-Frank and Basel III measures then on commercial real estate credit capacity and liquidity?
But some of the Basel III will definitely restrict commercial lending as we go forward. So.
Yes, sir. Any comments down the line? Okay. Are you starting to see a slowdown in the bank lending for commercial real estate as a result of or at least your experience, your background, your awareness from your other?
We've seen a slowdown since 2008, 2009, sir, and it's it's really been fairly stagnant in rural upstate New York. So.
What do you believe are the other factors that would contribute toward reestablishing the positive real estate environment? What would you, overall market conditions relative to tax reform, regulatory reform on banks? What are your major impediments that you see that are keeping back your economy in northern state New York?
I think there's a vast array of issues that are causing some of the issues in New York. I mean, we're seeing a migration of people out of our area. We're not retaining some of our youth. I think it's taxes, it's energy prices. There's a multitude of issues that's causing some of the issues, but it's obviously we try and be the economic engine in our communities, and anything that can clarify and help us make more loans into our community would be beneficial.
So you see that if we would be able to bring some clarity to this HVCRE rule and other impediments in terms of the regulatory environment, that would be an enhancement to our broader economy, and you feel the burden could be lifted on the financial institutions?
Most definitely, sir.
Okay, any other comments from any of the rest of you? Thank you, and I yield back.
Thank you.
Jill Muell's back. With that, we go to the gentlelady from New York, Ms. Maloney. She's recognized for 5 minutes.
Thank you very much, Mr. Chairman. And while I have some strong concerns with a few of these bills, other bills strike me as a good bipartisan effort to address very serious issues, such as Ms. Love's and Mr. Ellison's H.R. 864, Mr. Trott's bill with Ranking Member Clay on privacy notices, and Mr. Tipton's bill on mobile banking. I'd like to ask you, Mr. Estrada, I'm intrigued by Congressman Tipton's Mobile Act, which is trying to address a legitimate problem, how to make it easier for people who live in rural areas without physical bank branches to open bank accounts. What are your thoughts on this bill? Are there any potential unintended consequences from allowing financial institutions to use an image of a state-issued ID for purposes of verifying a customer's identity?
Thank you for that question. And as is our practice, like CRL is always open and encouraging access to financial products and wealth building. I think for this particular bill, just the concerns that we would raise is that the potential state preemption issues of the states that don't allow such practices and the consumer protections that don't kind of go along with.
But this would be a federal bill.
Right, so the states that don't allow the electronic storage or transmission would not have maybe the accompanying consumer protection laws for customer privacy or data laws. So that would be our concern, not so much in terms of expanding the access, especially to rural areas. It would be more the concern of once state laws are preempted that don't permit such electronic storage, what are the consumer protections that are present? Especially, every month or every couple of weeks, we're getting news of a information hack or breach from some of the richest and well-designed infrastructures in the country, never mind, regional banks. So from CRL's perspective, that would be the area of where we would have some concern.
Would anybody else like to comment on the bill?
If you don't mind, from a different, very human perspective, I have 3 daughters, and if I sit down and watch my daughters, they live on their cell phones. I mean, that is their operational life. I'm sure each one of you can sit around your family or in a restaurant and do the same thing. That is, we have to adjust in our environment to be able to serve people the way they want to be served, through the channels they want to be served. It is very important that we keep all that data safe, that data along with other data. But I really appreciate the effort of moving forward with something like this that helps us adapt and try to do it in a very safe manner.
Okay, anybody else want to comment? I think it's a real concern in these rural areas. Upstate New York has huge swaths of land that don't really have banks there.
If
Yes.
you don't mind, I come from a town of about 300 people, along with Congressman Luetkemeyer, and there are, there's 20 miles between the towns in many cases. So I really do appreciate your response there.
I would also support this idea as essential to bringing a new generation of millennials into banking products, and I think it's also going to be essential in the fintech space. We're going to have to think in a big way about preemption in the fintech space for it to work, not just with respect to licenses, but with respect to a wide variety of issues.
Thank you. I'm rather intrigued by it. And I'd also like to ask you, Mr. Estrada, about the CFPB's authority to penalize abusive conduct. And one of these bills, H.R. 2133, would repeal the CFPB's authority to penalize abusive practices and conduct and acts. And even though the CFPB has used this authority many, many times, most recently when Wells Fargo had the fake account scandals, the Choice Act contained a similar provision, and I offered an amendment to reinstate this authority over abusive practices. And one of the arguments we heard from the other side of the aisle was that the CFPB did not need separate authority over abusive practices because any practice that would be considered abusive would also be illegal under other laws. Can you address this argument? Why is it important for the CFPB to have the authority to penalize abusive acts and practices separately?
I'll answer that quickly because I know I'm running out of time. I would just express a strong concern about melding those two terms together, and that both of those terms, especially the abusive, has specific definitions in Dodd-Frank and that have specific definitions that apply to different practices. So to say that one would be the other is a fallacy.
Thank you. My time's expired.
Ladies' time's expired. With that, we go to the gentleman from Tennessee. Mr. Kustoff is recognized for 5 minutes.
Thank you, Mr. Chairman, and we do want to thank the witnesses for appearing today and indulging us when we had to take our recess earlier. Mr. Fisher, I do appreciate your comments that you made about the bill that I'll be introducing, the Securing Access to the Affordable Mortgage Act. And if I could, I'd like to ask you and Mr. Nichols, both if I could, as it relates to that. I think we can all agree that the American dream affords being able to purchase a home. Now, for many first-time homebuyers, that ability has become just that, out of reach for a number of them. Part of the problem is, my opinion, that in rural communities, and I represent West Tennessee, which is the Memphis area, but I've also got a lot of rural part of West Tennessee, we lack an adequate number of qualified appraisers. And under the current standards, as I think you all know and you've talked about, the cost associated with an appraisal on a real estate loan are high compared with the property's purchase price. If I could, Mr. Fisher, from your standpoint, from a real-world perspective, can you explain to us how the current home appraisal process has impacted mortgage loans on community banks like yours?
Sure, we're in a very small town, part of rural upstate New York. Spencer is a village of about 860 people. It was that in the year 2000. It was also that in the year 1900. So it's been pretty. I think there's different people, but the appraisal process it becomes difficult. We've definitely seen a reduction in the number of appraisers certified appraisers that are available to do appraisals for us in some of our rural markets, which has increased the price and also delayed the delayed the turnaround time in getting an appraisal done. So it's lengthened the process, it's increased the cost to the borrower, and it's just, I'd say it has had a very negative impact on borrowers.
Thank you. And Mr. Nichols, can you talk about that perspective from a credit union perspective?
I can. So my question would be, have you ever heard of St. Elizabeth, Missouri? Jamestown, Missouri, Centertown, Missouri. Appraisers haven't either. You cannot get comps. That's a severe issue. So when you go to those more rural areas, to meet the secondary market guidelines that were established post-crisis, you cannot get reasonable comps. So it is a tremendous issue. Underwriting, we both share the same issues on trying to get a reasonable appraisal. A lot of the rules that came into the appraisal process were needed, and I think we have much better appraisal rules. However, the recognition that the cost of appraisals have gone up and the ability to get appraisers is really tough.
Thank you. And Mr. Fisher, going back to you for a moment, if you could wave a magic wand and create a standard for appraisals for properties, how would you craft it? What dollar limit would you look at? What would be the criteria that you would look at to make it fair?
I think your proposal to have a $250,000 limit on a loan is very reasonable to be able to do an in-house evaluation on, or in-house, some type of an independent review of that property value. I think that would definitely make the process less expensive, quicker, and still, most of those loans we're portfolioing anyways, so the risk falls on us to do a proper evaluation, so.
You may have said, what is the population of your community?
The county that I live in is about 50,000 people, Tioga County. It's the population of the town of Owego is probably about 10,000. So,
thank you, Mr. Nichols. I'll ask you the same question. If you could craft a law, create a standard, what would it look like?
Again, I do agree with 250,000 for in-house loans, and again, that local expertise that we can rely on is very valid, and we understand the risk involved there and understand the properties.
Thank you very much. I yield back the balance of my time.
Thank you.
Gentleman yields back, and with that, we go to the gentleman from Washington. The distinguished Mr. Heck is recognized for 5 minutes.
Thank you, Mr. Chairman. I think it was just last week we had a pretty interesting hearing, and part of the conversation got toward the regulatory burdens associated with compliance with the Bank Secrecy Act. I looked at the notice for this week. I kind of got excited. I'm one who believes there should be some regulatory modernization. But I said last week, I'll say again, I went on an extensive tour, literally over a year's period of time in my district, visiting with small and large and medium-sized banks and credit unions. And I had a sole objective: show me your compliance burden. Walk me through your compliance burden. And the number one grievance I received was Bank Secrecy Act. And there are some good ideas in some of these bills today. Some of these bills are good. Some, I think, go, frankly, way too far. But I don't see any discussion of the Bank Secrecy Act. We could go small, CTRs, set in 1972 at 10,000. If I did my back-of-the-envelope calculation accurately and we held it harmless for inflation, we'd be talking $60,000 today. And I heard that everywhere I went. When they would stack the papers in front of me saying, this is what we have to do, an awful lot of it dealt with the Bank Secrecy Act. Now look, we all want effective counterterrorism and anti-money laundering and anti-organized crime safeguards in place, but the grievance I got was that the benefit is way out of proportion to the effort required, and frankly, the benefit was not transparent in many instances. So I know you're here today to talk about these other bills, but I guess I'm curious as to whether every financial institution in my congressional district is abnormal in this regard, or if you could say a sentence or two, Mr. Fisher and Mr. Nichols, about Bank Secrecy Act.
I appreciate the ability to make some comments. Bank Secrecy Act is by far, it's a huge burden on community banks, and we would greatly appreciate, a $60,000 CTR limit would be huge.
Let the record show I didn't actually specifically propose 60.
Just saying.
An appropriate adjustment as collaboratively arrived at.
But I mean, we're a bank, we have 97 full-time equivalent employees. I have one employee that is completely dedicated 100% to BSA. Plus, as a banker, we purchased software that we pay annual maintenance on because no physical person can do all the BSA monitoring that is required by us to do. One of the things that I do think would be great is if we got a tax credit for the money that we do spend on BSA, since it's really a government, it's helping the government out, not really helping my bank out, so.
Mr. Nichols?
BSA is obviously is an incredible burden. You can leverage the cost benefits. It is such an expansive piece of legislation. It would really be hard to cover that.
Do you agree that it is not apparent to those of you upon whom the compliance burden falls what the benefit is in proportion to the effort required? Or are you full-throatedly embracing the Bank Secrecy Act as written with every crossed T and dotted I in existing statute? If so, Mr. Fisher would like to talk with you after this hearing.
No, I think that's a loaded question because I think.
Oh, really? How perceptive of you.
Yeah. No, the BSA obviously is quite burdensome, as is anything CFPB related.
Well, it predated CFPB. Let's be clear about that. Mr. Estrada, I have one last question for you. I note with interest in your conclusion that CRL understands and supports the need for appropriate regulatory flexibility for small depositories. Okay, name two.
Name two.
Increased regulatory flexibilities that you think would be appropriate, because I think regulatory modernization is an idea whose time has come. My big issue in this committee is that we overreach and then get nothing. You have said, having put together some really well-written objections to what we would agree is regulatory overreach, that you think appropriate regulatory flexibility there's a need for. So be specific. Help us out here, Mr. Estrada. We're trying to make some progress.
And I did make a fine point on some of my oral testimony, especially considering BSA reform. We think there's a lot of promise in the ICBA supported having the identity of the account owner information verified at the time the entity is formed by federal or state agencies to take the onus away from the federal institution. If you want to go into mortgage, we said that I think that is a fair and effective increase of the QM standard of 200 basis points over APOR as opposed to 150, which would greatly expand the amount of mortgages that are currently excluded from safe harbor. So there are a few, and I'd be more than happy to send to your staff.
We would appreciate, I'm way over my time. You're incredibly indulgent. Thank you, Mr. Chair, and thank you. Please do send them.
Thank you.
Thank the gentleman from Washington. His time has expired. Just a heads up in response to your questions, gentlemen. That's the reason that we had an entire hearing 2 weeks ago on BSA. It is an important issue, extremely important, and it is something that the financial institutions have brought to our attention, and that's why we dedicated one entire hearing to that. But I appreciate you bringing it up again, because it is very important that we continue to hear from the folks who are in the field that have to deal with this issue, because it is very, very important. With that, we go to the gentleman from Georgia, Mr. Loudermilk. He's recognized for 5 minutes.
Well, thank you, Mr. Chairman. As it's been mentioned many times in these hearings, Georgia was specifically hit hard during the financial crisis. We lost more banks than any other state. And as Professor Vetter, I think, adequately stated, it was regulatory barriers, I think, is what is suppressing the creation of new banks, which has left a void in Georgia. We have 52 counties that have no community bank in them. And we have 3 counties that have no bank whatsoever, no bank branch at all. And So I'm really pleased about the hearing and the bills that we have here, but one of the bills that I'm a co-sponsor of, the Mobile Act, will actually bring some, I think, some common sense reforms to remove some barriers that allow a lot in our underbanked or unbanked communities, such as these rural areas that have no bank branch whatsoever, to use technology. The irony is Georgia is also leading in the fintech market in certain areas. So, Mr. Nichols, I was wondering, could you just mention how some of these common sense reforms would actually help, removing some of these barriers to implement technology?
So we'll talk about the Mobile Act in particular. I think, again, as we recognize the different channels that are becoming available, service channels that I won't even say younger people. It's all age groups that can use those channels to the rural areas. I think we forget about those sometimes as being underserved. And it's geographically underserved. They don't have the ability to get to our offices, or the times don't match, or whatever the case may be. So I think moving those channels, again, in my position of being a member-owned credit union, it's me listening to my members and saying we're trying to provide things that can help you be a better owner and better participant of the credit union. So I do applaud that effort.
And I know it doesn't specifically affect Georgia, it's maybe some other states, but I think Georgia's a good illustration is if you're in one of these counties that is unbanked, you may have to go 2 or 3 counties over to actually get to a bank branch to make a deposit or, do what we take advantage of being able to do day-to-day financial operations. So I appreciate your support for that. Another bill that I co-sponsor here is the CLEAR Act. And again, when you look at the regulatory barriers that is really suppressing the creation of new banks that would fill some of these other voids, especially with the small banks. I had a president of a small bank in my office the other day and was talking about the regulatory burden that was placed on his bank where he could not make a simple $3,500 loan to a gentleman he knows. He knows he would be good for it. He's got a family. He just wanted to buy a car, and his numbers just weren't there. And it was the consumer that was hurt by that. And I know that the CLEAR Act actually works on removing some of these regulatory barriers that are affecting small banks. Mr. Fisher, could you maybe address a couple of these of why it would be so important for a bill like the CLEAR Act?
Well, the CLEAR Act a lot of the mortgage relief, half of it's geared towards mortgage relief. It would definitely improve clarification. It would reduce some of the regulatory burden. When I came into the bank 25 years ago, we had compliance was a part-time position for somebody in the bank. Today, I've got, basically 2.5 FTEs completely dedicated to compliance functions.
And yours is a small bank.
And we only have 97 employees total, and the only person who doesn't have any compliance responsibilities in my bank is my courier that takes work between the offices. Everybody else in the bank has compliance functions that they are responsible for. So just the CLEAR Relief Act, or the CLEAR Act, would definitely help reduce that burden and help just narrow the focus down so we're more clear.
Do you think that with the CLEAR Act and maybe a combination of these bills would clear the way for the creation of new financial institutions that may be suppressed because of the regulatory burden?
I would greatly hope so, since there's only been 3 new banking charters since the financial crisis. So it would be nice to see, on average, prior to the crisis, we had about 100 new charters per year. So it would be nice to see some new charters coming back online for community banks.
Mr. Chairman, the way I see this is it's the consumer that's ultimately hurt by this. It's not the banker, it's not the institution, it's the consumer by these. And Mr. Chairman, I also have some legislation, the Fair Credit Reporting Act, Liability Harmonization Act, which I know you're supportive of, that I think would bring some common sense reforms, and I look forward to working with you on that as well.
Thank you, gentlemen. I look forward to working with you on that, and we are probably going to schedule another hearing September, October for another group of bills like this, so we want to include yours in that and have a further discussion at that time. So thank you for that hard work. With that, we go to the gentlelady from New York, Ms. Velasquez. She's recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Estrada, one of the bills we are reviewing today would allow the OCC to approve the granting of deposit insurance for a new operating national bank or Federal Savings Association. It is important to know that the OCC used to have this authority, but because of clear abuses, Congress abolished that authority in 1991. Do you think returning to this discredited policy puts the Deposit Insurance Fund at risk and threatens the safety and soundness of the banking industry or the banking system?
Thank you for that question. And in touching base with our research team and researching this bill, it is lost upon us on how this provision has targeted regulatory relief for small institutions. We think the FDIC is well positioned with a great history of managing financial downturns, the shuttering of banks, and to shift that responsibility or to expand that responsibility to the OCC, it raises more questions than answers, especially given the history of the program that you've outlined.
Thank you. More and more, Mr. Estrada, more and more Americans are moving to fintech business to meet their financial needs. Are you concerned that if this bill were passed and the OCC had sole authority to both grant charters and deposit insurance, they will largely be able to dictate the terms of the fintech charters without the input of other regulators?
Again, thank you for that question, and I think it's along the similar lines of my first answer, is that we recognize innovation, we recognize technological changes. CRL is a policy affiliate of a CDFI based in North Carolina and is very much informed by the industry. A great example of the concern we'd have is an OCC charter preempting state consumer law protections on payday loans, where we have very old school predatory lenders calling themselves innovative technology companies and able to avoid state rate caps based on a potential federal charter. So I think the OCC, while it has, leading the pack on this, I think there's a lot of discussion to be had in terms of what national charters will have on state consumer protection issues, especially when it comes to preemption and, like I said, old school predatory lenders calling themselves innovative fintech lenders.
Thank you. Mr. Chairman, I have a letter from the Conference of State Bank Supervisors that I would like to enter into the record.
Without objection.
And I also have a letter from over 40 civil rights and community groups, including the NAACP and the American Civil Liberties Union, that I would like to enter to the record. And these are letters that are raising a number of concerns about the proposals that we're discussing today.
Without objection.
Mr. Estrada, as you may know, I am the ranking member of the Small Business Committee. In that role, I have continually pushed for the expansion of credit opportunities for women and minority-owned small businesses. Unfortunately, there remains an information gap regarding the demographics of small business borrowers. Section 1071 of Dodd-Frank was designed to fill this gap and identify potential shortcomings in lending markets. Now, the CLEAR Act is seeking to repeal Section 1071. Can you explain the importance of collecting this data?
Thank you for that question. And yes, we are very much aligned with that in terms of the only way to combat structural and historic discrimination and exclusion is through robust data sets. And any effort to roll back the collection of data, especially among discriminatory behavior, whether it's disparate impact or intentional, is something that we're very concerned about. And again, I would just stress that it's not so much we're ignoring the cost implications of collecting these data. It's just that what's in the bill and simply blowing up thresholds and expanding exemptions beyond what seems to be reasonable is very concerning for us, especially when we roll, and it applies also to the HMDA and the 1071 data. We share your concern.
Thank you. I yield back, Mr. Chairman.
Gentlelady yields back. With that, we go to the gentleman from Colorado, Mr. Tipton, recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to be able to enter into the record letters of support for H.R. 1457, the Mobile Act, from the American Bankers Association, Consumer Bankers Association, the Center for Financial Services Innovation, Financial Service Roundtable, and the Innovative Learning Platform Association.
Without objection.
Thank you, Mr. Chairman. Thank the panel for taking the time to be able to be here. Ms. Nichols, I'd like to be able to start with you. According to a 2015 FDIC survey of the unbanked and underbanked, there are approximately 15.6 million adults considered entirely unbanked and another 51.1 million adults that are considered as underbanked. Is it concerning to you as someone who's president, CEO of a credit union that there are at least 67 million people who do not have adequate access to the financial system, cannot conveniently withdraw their money, control their finances, and may lack protections to be able to prevent theft of their funds?
Yes, actually, thank you for the question. I think it is a tremendous opportunity for us as an industry and, frankly, as citizens of the country to bring those people into the regulated and very growing service industry. It is much better for them to come out of, quote, the darkness and operating behind the scenes and be able to offer services such as mobile and technological services that can provide much better service for them.
Thank you, Ms. Nichols. And Professor Verrett, I'm very pleased to be able to have the broad bipartisan support for this legislation, as you can see on this committee. Without access to the traditional financial system and regulated financial institutions, what will happen to the unbanked and the underbanked without access?
Yeah, I think this bill is a terrific approach to promoting access for particularly low and middle income people who are having trouble accessing traditional services. I think it can be helpful to the traditional banking industry as well as to the new fintech space and alternative financial services industries.
I appreciate that answer. Do you feel when we're talking about the underbanked that unregulated lenders actually pose more of a threat rather than having something like the Mobile Act that's going to be going through traditional instruments like our credit unions, our banks, to be able to provide those services, making those in different circumstances maybe a little more vulnerable?
Well, it depends what you mean by unregulated lenders. If you mean lenders, non-traditional lenders regulated at the state level, I wouldn't say that's necessarily more risky than the traditional banking system, but if you mean sort of loan sharks and folks making illicit loans, I would certainly want to discourage that and provide people with other opportunities.
Yeah. The FDIC also found that the unbanked and underbanked rates were higher among these following groups: lower income households, less educated households, younger households, Black and Hispanic households, working age disabled households. As we discuss these legislative policies and encourage financial inclusion, does the FDIC survey results corroborate with what you see currently, Professor?
There was some good news in 2015, but not nearly enough in terms of the FDI survey of the unbanked and underbanked. We can do a lot better, and so I certainly salute this committee's efforts to do so, particularly with this legislation.
Thank you. And just one more question for you, Professor. According to the same survey, roughly 4 in 10 unbanked households and 3 in 4 underbanked households have access to a smartphone. The FDIC concluded that the use of smartphones to engage in banking presents promising opportunities to use that mobile platform to increase economic inclusion. Would you agree with that statement?
I do, and unfortunately, I think the FDIC hasn't stayed true to that observation. We've already seen some hostility to fintech among at least the existing FDIC management, certainly with respect to how they regulate bank services providers. I think they're fairly hostile to the fintech, to the future of fintech, and so I'd prefer they stay more true to that observation. I think they're right about that.
Great. Thank you, sir. Mr. Nichols, my legislation, the Mobile Act, would create regulatory certainty by explicitly allowing financial institutions to be able to verify customer identity by copying a state-issued driver's license or personal identification card through the mobile app. As CEO of a financial institution, do you see the merit of engaging future customers through a mobile banking platform?
Absolutely. So let me back up and describe just a little bit about my credit unions. We're located in Jefferson City. We serve healthcare people we serve, Missouri National Guard people we serve, people that work for Missouri Farmers Association. All those people are spread throughout the state of Missouri and in many cases in other countries. So the ability for us to actually grab that data without physically being in touch with them is a tremendous benefit for them and for my credit union.
Thanks so much, Mr. Chairman. I yield back the balance of my time.
Gentleman's time has expired. With that, we go to another gentleman from Missouri, Mr. Clay. The ranking member is recognized for 5 minutes.
Thank you, Mr. Chairman. This is a question for Mr. Estrada, Fisher, and Mr. Nichols. Mr. Fisher, the organization you represent, ICBA, along with other bank associations, wrote to Congress saying, "We are gravely concerned that the administration's forthcoming FY 2018 budget may propose cuts to the CDFI fund. We strongly urge you to maintain strong funding levels." The letter goes on to say, during the 2016 presidential campaign, the need to create jobs and revitalize the economies of disenfranchised rural communities and neglected inner cities was a key theme. CDFI banks work in the exact communities that were the focus of this conversation. Community-based financial institutions are uniquely positioned to understand local credit needs, which is why there is historic bipartisan support for the CDFI fund. And yet the president's budget, as well as the appropriations bill the House Republicans are advancing, would severely cut the program by nearly $60 million or 23%. Mr. Fisher, should Congress follow President Trump's lead and impose severe cuts on the CDFI fund? And if so, if they do that, who will lose?
I'm not educated enough to tell you who's going to lose, but I do know that ICBA does support funding the CDFIs, so I would say that we would back the idea of continuing to fund the CDFIs where they've been funded, so.
Okay, all right. Mr. Nichols, what are your views on CDFIs? Should Congress maintain strong funding for this program?
I'll back up and say we are a CDFI. We are CDFI certified, so absolutely. Those dollars that go to the institutions help in programs and reinvest in those communities and my members in this particular case. So absolutely, we would really appreciate the funding in that program.
Thank you for that response. And Mr. Estrada, I understand self-help, a credit union that CRL is associated with, is a CDFI. How problematic are these steep proposed cuts to that fund?
Thank you for that question. Yes, and that's correct. We are the policy affiliate of Self-Help, and we have firsthand knowledge of the importance of CDFIs throughout the country for very much the same reasons that you pointed out, of accessibility, serving communities that would historically be disenfranchised from mainstream banks, whether they're underbanked. We strongly support robust funding for CDFI and would be at the forefront of those fighting against any cuts and the effects that would have.
Yeah, thank you for that. And Mr. Estrada, we received a letter signed by over 40 civil rights and consumer groups opposing H.R. 2133 or the CLEAR Act. These groups said that H.R. 2133 includes a number of provisions that would, under the innocent-sounding guise of regulatory relief, drastically undermine our nation's most important civil rights and consumer protection laws. They also highlighted how the bill changes fair lending laws, changes data collection standards for mortgages and small businesses, and weakens the Consumer Bureau. Do you share these concerns, or could you discuss who would be harmed by these changes?
Thank you. Yes, and we are very much in support of that letter and realize that, as I said to a previous question, a lot of the discriminatory lending, a lot of the adverse effects of implicit bias require robust data collection to really track and find where this behavior is going. And rolling back the collection of data under a guise of cost is not lost upon us, but there is a trade-off. And in a lot of I think what we're disagreeing on is really methodology as opposed to result. I don't think anybody is for discrimination, just how we're going to root out the problem. From CRL, from a lot of the civil rights advocates that signed on to that letter, say that this data is not only crucial but necessary to get the market analysis of where discrimination is happening, both historic and, like I said, on the individual level.
And I appreciate your response to that, and Mr. Chairman, I yield back.
Gentleman yields back. With that, we go to the gentleman from Michigan. Mr. Trotz, recognized for 5 minutes.
Thank you, Mr. Chairman. I want to also thank the panel for their time this afternoon. Professor, I want to start with you. And do you think the UDAP authority that's given to the CFPB is necessary to keep these rogue financial institutions accountable? Or do you think, on balance, it in general compromises financial institutions because it creates confusion and uncertainty regarding their business plans?
I believe that the authority that predated Dodd-Frank under UDAP, the unfair and deceptive practices prohibition, provides more than enough leverage to the CFPB to go after bad actors. I think it most certainly would have covered, without the abusive sort of unclear section, it would have most certainly covered all of the activity at Wells Fargo. That clearly falls squarely within deceptive practices. Anybody who knows that story knows that. The abusive definition, just going through how the CFPB has utilized its sole abusive authority when it's brought solely abusive actions, it's often, you see some settlements there that stretch the rule of law, to me at least, including one in which they went after abusive practice for saying, well, this provision was just too far down in the contract, too deep in the contract for anyone to read, and so it must have been abusive because it was on page 100 rather than on page 1. That strikes me as highly problematic in a rule of law culture.
Yeah. You think some of the changes in the chairman's bill that we're considering with respect to the CFPB will on balance, help consumers more than hurt them?
I do, absolutely, yes. And with respect to data collection, I think we have to do a balancing test, a cost-benefit analysis on data collection. Look, the IRS would love to get unfettered access to all of our bank accounts. I have no doubt it would help the IRS catch tax cheats. But I don't want the IRS just digging through my data. It's too cumbersome, and I have financial privacy. I think we can think about that in the context of HDMA and other collection, especially when the SBA is already collecting a lot of this data anyway.
I want to switch topics. Thank you, Professor. Mr. Fisher, so last Congress, we worked to streamline some of the privacy notification requirements relating to community banks. Has that affected your operations at all?
The privacy notices, not having to send out a privacy notice annually if you haven't changed it, has been a very positive impact for my bank.
Had good impact on your customer service?
Privacy hasn't really affected our customers.
People probably aren't calling saying, what is this and why?
No, people are definitely not calling asking, why am I getting this notice again?
Although they probably missed that stack of paper next to Mr. Nichols. I know that's for mortgage origination, but it's good coloring paper for their kids, I suspect. Save some money because of it?
We've definitely saved some money. I'm not sure I can quantify, but I know it's obviously less postage, less paper.
Sure. What did you do with the money?
What I do?
Maybe lend it to some businesses, or
definitely, it's been put back into use in the community as far as more loans and trying to.
Sure. If a customer calls asking for the notification, you send it to them?
Sure, of course.
You charge them for it?
No.
Okay. So Mr. Clay and I co-sponsored a bill, the Privacy Notification Technical Correction Act, one of our tougher acronyms here in town, and it largely expands the scope of these disclosures, and I think it will be beneficial. Mr. Nichols, I want to talk about your credit union for a minute. How many years have you been in business? The credit union.
How many have we been in business?
Yeah.
We opened in 1954, September to be exact.
And you said earlier you have about $200 million in assets?
Yes.
How many employees, again, dedicated to compliance?
70, to compliance, we have 2 full-time employees.
People. So do you get sued very often by your members?
No. Our members own us. So it seems that would be like suing yourself for the most part.
So you think that's Dodd-Frank have anything to do with it, or you always ran a good operation and really didn't need the benefit of all the regulations?
I will go back and say the definition of credence. We are.
Okay, we'll switch to it, so certainly your members don't want to sue themselves. Mr. Fisher, how about your community banks?
We have not been sued by our customers. To my knowledge, in our 150-year-plus history, we've never been sued.
Great, okay. Thank you. I yield back, Chairman.
Gentleman yields back, and we go to the gentleman from Texas, Mr. Green. It's recognized for 5 minutes.
Thank you, Mr. Chairman, and I thank the ranking member as well. I am a son of the South. What the Constitution accorded me, my friends and neighbors took away from me. I lived through invidious discrimination. I know what it looks like. The KKK burned a cross in my yard. I know what it smells like. I had to go to filthy waiting rooms and colored restrooms. I know what it sounds like. I've had ugly things said to me. So I know what invidious discrimination is like. I know the harm that discrimination can cause. And I'm very much concerned about Section 7, which reads, it amends the Equal Credit Opportunity Act and the Fair Housing Act to require intent to discriminate. I'm very much concerned about this because whether by accident or design, discrimination still hurts. The pain is not eased simply because it was done without intentionality. And I'm talking about H.R. 2133, Section 7. So I'd like to visit with Mr. Estrada for just a moment. Mr. Estrada, does making the requirement one of intentionality to have a cause of action, does that in some way decrease the harm that's caused when one is discriminated against?
That particular question, absolutely not. It doesn't decrease the harm caused just because it was intentional or in effect rather than in intent.
And does it benefit the people who are discriminated against to require intentionality?
No, in fact, I would say it puts a barrier toward equity.
Do you find that discrimination exists in banking?
Yes, I mean, there's a long history of not only discrimination in the marketplace, but through federal government programs with FHFA and redlining. So I think there's more than enough evidence on both the industry and government side to show that.
When you balance the benefits with the liabilities associated with this, do the liabilities of doing this outweigh the benefits such that it's just not a good thing to do for people who are being harmed?
I'd agree with that, but I would reframe that. I think that it's a privilege to look at racism in a cost-benefit analysis. I think if you're the victim of racism and discrimination, you don't have the privilege of saying, you know, what is my feelings compared to your data collection efforts. So I would think that, especially around the issue of disparate impact, which has been upheld in the housing discrimination cases with the Supreme Court, employment cases all the way back to 1970, that racism is not a cost-benefit question. So while we want to be supportive of industry and be mindful of the costs that it would take to collect data to root out systemic discrimination, I think that having the privilege to say, what's the cost-benefit of racism versus how much I have to pay to collect that data is a very dangerous way to approach the problem.
Thank you for your very thoughtful response. I would just end with this. If you haven't known the pain of discrimination, it can be difficult for you to appreciate my commentary. But when your neighbors deny you what the Constitution accords you, it can be very painful. And there are a good many people in this society that will never suffer any pain if we make this change. But there are a good many other people who will be subject to harm if we do so. And we ought to want all people to have the same opportunities in this society. This is a bad piece of legislation. I absolutely oppose it, and I want my record to reflect that I would never support something that's going to harm people in this fashion. I yield back the balance of my time.
Gentleman's time has expired. With that, we go to the gentlelady from New York, Ms. Tenney. She's recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, panel. You're finally at the end, I think. I just want to first, before I get started, just say thank you, and it's an honor to have Mr. Fisher here, someone who hails from my region, and we talked a little bit about it earlier with Chairman Yellen, how rural our area is and how difficult it is for our community banks to survive. And I appreciate your testimony dealing with a number of issues. As a former bank attorney, I represented a number of community banks. You discussed really great issues, and we think we have some solutions on the mortgage end. And just wanted to just welcome you and say thank you for being here and helping advocate for our region and for what the real problems are in communities like ours that are struggling with, as you say, high regulatory burdens, taxes, outmigration of people, and all those things. And I just want to say thank you to you. I don't have any questions. I think you've been asked an awful lot of questions today because you really define what's going on in our region, which is I call the Rust Belt of New York. I wanted to focus, just switching gears a little bit, to Mr. Verrett and Professor Verrett about just some of the issues surrounding the concern about the lack of de novo charters being started in the nation, and credit unions for that matter, since the passage of Dodd-Frank in 2010. It's my opinion that the lack of new banks has been an issue. We talked earlier speaking with Janet Yellen about the number of community banks that are just buildings on corners overgrown with grass, and we've lost many of them, or they've been merged into larger entities, and it's hurt our small business community and our ability to lend to smaller institutions. Thankfully, we have banks like Tioga Bank still forging ahead in a small community and providing those vital services to our rural residents. But since between 2000 and 2008, we had almost 1,400 new institutions. Since 2010 and the passage of Dodd-Frank, we've had 5 new bank charters, 16 new credit unions chartered in the United States. And so I guess I'd like to ask you what your opinion would be and how we can increase the number of de novo charters, streamline the process, and make it easier to bring them on board. If you could comment on that, please.
Sure, thank you for that question. An analysis by the Federal Reserve Bank of Richmond points to the problem, diagnoses the problem of a lack of de novo charters squarely in the regulatory field. Overregulation is the problem, particularly with respect to the chartering process. The intent was never for, I think the intent behind the design of federal banking law, which has primary federal regulators and secondary regulators, was to make sure that regulatory turf wars, bureaucratic turf wars, didn't prevent new chartering and didn't prevent lending and growth.
Are you referring to the dual approval process? Is that what you're referencing?
Sure, that's part of it. That's an important part of it.
Okay.
And I think this is a great idea. And I would look to a number of other ideas that have been raised, like providing more corporate governance flexibility for new banking institutions as well. But that's absolutely the key to the problem, and so I commend that.
So streamlining it, would you go to obviously would require insurance. We wouldn't want to have any of this leak into areas outside of the chartered banks, banks union, or banks issue. Can you just tell me what you feel about how we would manage that, say if we were to draft legislation on dealing with the dual aspect of the process with FDIC versus OCC? How would you reconcile that?
Well, I think both with respect to chartering and also with respect to the exam process. I think an institution's primary federal regulator ought to be given some deference. This is a problem in examination as well, where we have examiners examining the same thing within a few weeks of each other and not even connecting in any way on specialized exams. So I think the OCC's determinations of chartering and its own reputational risk as an agency are going to keep it from doing anything inappropriate. And I also think with respect to the fintech space, though most fintech firms are probably not going to need deposit insurance or take deposits, some of them might, and so I think this will be important in that arena as well.
Thank you very much. I thank the panel and again, Mr. Fisher from our region. I really appreciate it. And I yield my time back, Mr. Chairman. Thank you.
Gentlelady yields back. With that, we go to Mr. Emmer from Minnesota. Is recognized for 5 minutes. Welcome.
Thank you. Thanks to the chair for holding this hearing and for allowing me to participate. And thank you to the panel. Appreciate you being here today and taking all this time. In particular, just wanted to recognize Mr. Fisher and Mr. Nichols. The community banks and credit unions are incredibly important to my state, as I expect they are all across this country. You know, in 2008, at the time of the financial crisis, we had about 8,000 of each across the country. A year later, a year after the crash, we still had about 8,000 community banks and 8,000 credit unions across this country. Now, it's been almost 7 years since Dodd-Frank was passed, and we're left with somewhere around 6,000 of each. I believe we need everyone in the financial services food chain. We need the biggest banks. We need the regional banks, community banks, and credit unions, everyone. It just so happens, though, that the community banks and credit unions support all of our small communities. Because I can guarantee you, if you live in Mora, Minnesota, you're not going to Goldman Sachs for a loan. If you live in Halleck, Minnesota, you're not going to go to a Citibank. And if you live in Tower, Minnesota, which some of you might have heard, sometimes is called one of the coldest spots in the country, you might remember those battery commercials they used to do in Tower, Minnesota. You're not going to go to J.P. Morgan Chase. You're going to go to your local, probably family-owned community bank or credit union. It's imperative that we enact policy that would allow these financial institutions to survive and thrive again, which is why today's hearing is so important and timely. And there are several excellent proposals from this committee and in Chair Lutemeyer's Community Lending Enhancement Relief Act, Regulatory Relief Act. There are two, though, that interest me today. One of the chair's proposals would amend the FDIC's definition of a deposit broker that will allow for reciprocal deposits so community banks can keep money in the local community that usually is used by community banks, minority-owned banks, community development banks, that sort of thing. And the other one would amend the Home Mortgage Disclosure Act of 1975 to exempt small banks and credit unions from Regulation C if they have originated 1,000 or fewer closed-end mortgages in each of the preceding 2 years, or if they have originated 2,000 or fewer open-end lines of credit in each of the preceding 2 years. I guess I'll start with Mr. Fisher. Can you tell the committee why the reciprocal deposits are so important, especially right now?
Well, reciprocal deposits are, it's a great source of fund. If I look at my bank personally, we have about 30% of our total deposits are municipal deposits. And municipal deposits, anything that exceeds FDIC insurance, we have to have a bond pledged against that deposit. So with reciprocal deposits, we can get full FDIC coverage using reciprocal deposits. However, there's still kind of a negative perception about reciprocal deposits because they're considered brokered funds. So we would greatly appreciate this amendment so that they would not be considered brokered funds.
Well, because what's the alternative if you don't fix this? What's the alternative? The money leaves your community, doesn't it?
Correct. The money, there's obviously, as rates are increasing, lending's increasing, deposits are our raw materials. That's what we lend out. Right. So,
and we want to put it to work in our communities, our small communities.
And so we really don't want to see municipal deposits go out of our local communities because that's helping to fund growth in our communities. So.
Right. And this, why don't I expand it to Mr. Nichols? There's been some talk here, and in the little time left, there's been some talk about the 48 points, all this information. I think the chair started the second part of the hearing talking about a closing where he was trying to sell property, and there's this big packet. Why do we need all of this information that the CFPB has put in this rule? Why?
We don't, and the consumers don't want it as well. Again, I'll go like this, but the more paper that we give to the consumer, the less they read, the less informed they are. It is a more expensive process, which ultimately, guess who pays for that process?
Well, and very quickly, community banks, credit unions, people on the lower end of the financial system, they're getting out of the business.
Right.
So it's not even that we don't read it, it's that we may not get the choice.
That's actually a great point. It's good to have multiple options. We'll go back to another congressman's point in that the more options you have, the less systemic risk you have by having the too big to fails out there, and the more choice you give to the consumer.
Great. Thank you again, Mr. Chair, and thanks for your patience.
Gentleman's time has expired. With that, we'll go to the gentlelady from Utah, Ms. Love, recognized for 5 minutes.
Thank you. Thank you all for being here today. I'd like to broaden our focus now to a consumer issue, that of debt collection, which is the topic of H.R. 864, the Stop Debt Collection Abuse Act of 2017. Every year, millions of Americans are touched by debt collection, many of them low to middle income families. In fact, the CFPB's most recent monthly consumer complaint report in June 2017 showed that the most complaint about financial product or service was debt collection, including in my home state of Utah. Within the broader topic of debt collection, I'd like to focus on the federal government's use of private debt collection and agencies to assist in its debt collecting uses and efforts. Under the Debt Collection Improvement Act of 1996, many federal agencies can, after a prescribed amount of time, refer delinquent federal non-tax debt to the Department of Treasury for collection activity by an approved private debt collection agency. In addition, some federal agencies, such as Department of Education, manage their own use of private debt collectors. Most notably, the IRS was recently mandated under Fixing America's Surface Transportation, or the FAST Act, to revive its use of private debt collectors to collect delinquent individual income taxes, and started doing so of April this year. Yet questions have been raised about the federal government's use of debt collectors or private debt collectors. In recent years, the Department of Education announced that it was ending contracts with 5 private debt collectors that have been providing inaccurate information to borrowers about loan rehabilitation programs. In addition, there are significant concerns about the IRS's renewed of private debt collectors, particularly with regard to private and consumer protection, including fears that scammers will pose as IRS debt collectors to commit fraud against vulnerable individuals. So in a nutshell, this is about making sure that the federal government complies with the same activities that the private sector when it comes to collecting debt. So I'd like to start by asking whether anyone on this panel has been tracking the most recent round of debt collectors being hired on behalf of the IRS. I know it's very recent, but do we have any feedback on that program yet? Maybe Mr. Estrada, do you know anything about that?
Well, at CRL, we do support the provisions of debt collected by third-party collectors for the federal government. In terms of the Henson case, we're still assessing the impact of the decision and how it relates to that. So I would love to stay in touch with your staff as we work through it ourselves and keep you updated on what we plan on putting out.
Okay, so just to give everyone an idea, H.R. 864, the Stop Debt Collection Abuse Act, is a bipartisan effort on behalf of myself, Representative Ellerson, Representative Cleaver, and Representative Hill to make sure that the federal government uses the same practices that the private sector uses. Also, just as a follow-up, have you tracked any other issues with private debt collectors hired by the federal government? Does anyone Has anyone tracked any of those activities or thought that maybe have something that they can share?
I haven't tracked that, Congressman Love, but it strikes me that the proposal you're talking about, that particular section of the bill, is consistent with the Taxpayer Bill of Rights that I think would be relevant. And so it sounds like a pretty good approach to me.
Okay, anyone else have anything to offer? No? No? Not in, okay. I'd also like to talk more generally about the role of debt collection in consumer credit life cycle. So the Federal Reserve Bank of New York recently published a report confirming the important role of debt collecting in the credit-based economy. The analysis found that restricting collection activity leads to a decrease in access to credit across the full spectrum of borrowers, and to the deterioration of indicators of financial health. So it's very important, as always, that we find the right balance between protecting consumers and making sure we don't inadvertently restrict credit availability. Just really quickly, Mr. Fisher, as the two bankers on, Mr. Fisher, as one of the two bankers on the panel, can you tell us about the significance of debt collecting and the availability of consumer credit?
I mean, we handle our own debt collection. We don't outsource it at all. So if a loan goes bad, we handle it ourselves. And I mean, obviously, if a bank takes a loss and they're not able to collect on their debts, it's going to make them less likely to lend money out again. So,
okay, thank you.
Gentlelady's time has expired. With that, we go to the gentleman from Indiana, Mr. Hollingsworth. Welcome, and recognized for 5 minutes.
Mr. Chairman, thank you so much for the time, and knowing that I'm not on this subcommittee, thank you for allowing me to crash the party here. One thing that I am absolutely passionate about is making sure that consumers have more and more choices in the products that they want to use. Because ultimately, as I think Sam Walton said, consumers tend to choose with their feet, with their wallet, the products that win and lose. And what I know I hear every single day in district is that they are tired of bureaucrats in Washington telling them what products they should be able to choose, what products they shouldn't be able to choose, what those products should look like. They want to get a multitude, a cornucopia of offerings, and then be able to decide themselves what they want. And I know what I hear from not just banks, not just credit unions, not just lenders, but from every company as well that I'd run into, is that they are tired of servicing a bureaucracy in Washington, a regulatory state in Washington, instead of servicing their customers, instead of working for their shareholders, instead of working for their mutual owners. They're tired of servicing this bureaucracy that puts more and more demands on their business, on their time, and not allowing them to, and standing between them and their customers. And where this really comes to the forefront for me is with Deposit Advance product. Now, this is a product pre-2013, short-term, small dollar line of credit product that people loved, that they were utilizing day in and day out to be able to help their families make ends meet with cash flow needs. That over and over again at each of the institutions that were offering this product, it got rave reviews and was used very, very frequently to help families prepare for their future, prepare for a short-term problem, and ultimately be able to help to rebuild their credit because they were reporting to credit agencies. But then 2013 happens. The OCC and the FDIC issued guidance and said to all of these lenders that even though this is a short-term, small dollar product that was really a line of credit, that it should be treated like a loan, and they had to underwrite each one of these like a loan. Whether they were loaning $100,000, had to be treated just like that if they were loaning $100 through this product. And that's a real travesty because all of a sudden those lenders stopped being able to do this because the cost was too high. The regulatory burden in presenting these products to the market was too high. And so instead of consumers getting the opportunity to choose, right, the bureaucrats got to choose. And the bureaucrats got to say that they didn't want this product, even though consumers had said over and over again that this was a product that fit their family's needs. So I'm proud with my colleague across the aisle, because this is a bipartisan issue, to sponsor and have written the Ensuring Quality Unbiased Access to Loans Act, or the EQUAL Act, where we go back and rescind that guidance and enable consumers to choose exactly the type of products that they want and allow these lenders to be able to make those type of decisions themselves rather than the FDIC and the OCC making these decisions for them. And I really wanted to first talk about that and thank Mr. Meeks across the aisle for working with me on that. And then, Mr. Chairman, I wanted to ask unanimous consent that I am able to enter this letter of support into the record.
Without objection.
Thank you. And then I want to direct my first question to Professor Verrett and really talk a little bit about your view, A, on the product, B, on the opportunity that we have to roll back a regulatory intervention to prevent consumers from being able to make decisions that are best for their families, best for their futures, and best for their financial needs.
Sure. Well, the Federal Reserve indicates that over half of all families couldn't cover an emergency expense of $400 without selling something or taking out a loan.
Right.
So this literally keeps the lights on for some people.
Right.
Deposit in, I think small dollar lending in general is helpful to the economy in a variety of different forms. One form is deposit advance products, which use the history of direct deposits to make some gauge of the riskiness of a borrower, which is one of those technological innovations that we didn't have even in the 90s. So I think it's helpful. I think that Mr. Meeks requested suggestions for, I guess, compromise approaches. One of the approaches I think is most egregious is at least in the CFPB's piece of small dollar, is the portfolio default-based regulations, which I think could set an institution up for huge reimbursements for macroeconomic things way outside of their control. Right. And then the final point I would say that makes your legislation very reasonable is that it just asks for notice and comment, right, which, let's not forget, the Administrative Procedures Act was led by a very liberal progressive senator right, some 60 years ago. So I think it's a very reasonable suggestion.
Well, I appreciate that so much. And just as a closing remark, I wanted to talk about just the wide spectrum of individuals this has the opportunity to touch. It's been estimated that over 50% of the customers that use this have incomes of greater than $50,000. 25% of the customers have incomes of greater than $75,000. This isn't just to help low-income, moderate-income families, but to help everybody get through a tough period. And I think one of the great misfortunes or malintentions from overregulation is that it's helping that marginal customer. And what getting back to a smarter regulation enables us to bring them back into the banking system, bring them back to participating in our financial system to help their future. So I thank the panelists for their time and appreciate the chairman for letting me have some time here today.
Gentleman's time has expired, and with that, the questioning is at an end. You guys have survived. Congratulations. Thank you very much for your patience to wait out our votes and for your willingness to be here today and for your expertise. I know we've talked about a lot of bills today, and some of those bills have got a number of parts and some of the things we probably didn't get to, but your comments are very important to give us some insights, both pro and con, on some good things and some amounts of good things so we know where to go and what pieces that we need to work on and get, move and make better. But I think, it's our sincere effort to try and, number one, give some relief to some small and financial institutions to be able to help them not just to survive because of the pressure of the continued increasing cost of doing business, but to also better serve their communities and to be able to help those communities and grow and prosper, because at the end of the day, that's what this is all about. That these businesses that you guys represent today do not survive unless you have communities that are growing and thriving. You live off the customers that you have that you can help to make their lives better. It's a symbiotic relationship that you have to have with your customers, with your community. If you grow, they grow. If you don't, they don't. And it's coming from a small town, I can tell you that's the way it works. So it's very important that you're here. We sincerely thank you for your time and your efforts. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, this hearing is adjourned.